Well, welcome to another episode of Break Away from the Rat Race. And today I have the pleasure of speaking with Paul Winterrode. Paul is both an expert debt provider and an active multifamily practitioner with real-world experience investing in multi-assets, both as a general or limited partner. Because of his experience on the investment side of the business, he has some deep insight and empathy for his clients and needs as he helps them navigate through the financing process. So Paul has successfully sourced financing across the country for market rate, affordable apartment buildings, student housing, and senior housing projects. So Paul, welcome to the show.
Eric, great to be here. Thanks for having me on.
That was a little bit of a mouthful, a tongue twister there. So, but the gist of it is that you invest in real estate, and so you know what, as real estate investor, what we're looking for, what kind of financing we're looking for in order to make these deals work. So, tell us more about kind of like what you do and why you got started in that business.
Yeah, no, happy to do it. I'm very much a real estate guy. In fact, the funny side story, it's important to have liquidity, right? And savings accounts and those sorts of things are going up. But I hired an investment advisor for some equity investing to have some liquid positions, and he actually fired me as a client this morning.
Oh, really? Wow.
I'd had some complaints as far as benchmarks and what was going on, and he was like, "Oh, maybe this isn't for you." So, real estate is where I live most of the time. So, anyway, to get back to the question, so I got into business about 8 years ago. So I'm kind of middle of my life career. I'm 45 years old and didn't have a whole lot of direction career-wise. Always had an interest in real estate and dabbled in some flips and spec homes and that sort of thing, but mostly in the residential space and more, you could call it more of a hobby or an interest than a real business at that point. But had a really fortunate moment where the employer I was working for decided to close down the division I was a part of. And so I did some soul searching and really got in tune with what I wanted to do with my career. And I'd always been intrigued with apartments, and I thought, wow, that'd just be great if I owned apartment buildings. Those guys or gals, whoever owns them, they have it made. That seems like a pretty good gig. So did a lot of networking and was able to start a position as a mortgage broker. Mm-hmm. And so that's where I started cutting my teeth, really in the back of my mind, thinking, okay, how can I get more involved in investing in apartments? And if I can understand the finance side, I can certainly figure out what a good deal is and do that. So as just being completely immersed in the space in the industry, things moved quicker than I anticipated as far as getting involved in ownership of apartments. And through that network, partnered with an individual, and we bought 3 apartments. I'm in Salt Lake City, Utah, so they were smaller multi family projects, 7, 13, and a 20 unit heavy value add. And that's how it all got started. Mm-hmm. And that was on the general partner side. We raised equity, so we had limited partners, and the market, and this was around 2017, 2018 when we got into those deals and had real successful exits, and got involved in a couple other multifamily projects as a general partner, and decided through that process, because being the general partner, being in charge of everything is very much a job. You are running a business, and especially if you've got multiple properties. And so when I started, I was like, I would never want to be a limited partner. And now I'm almost exclusively a limited partner. I've shifted to that mindset just because I I really like the mortgage business that I'm a part of, and it helps me meet great people and meet sponsors and get access to opportunities I may not have otherwise, and it also keeps me sharp on what to look for.
Mm-hmm.
So yeah, as of today, I'm very much the day job is in the is a mortgage broker,
Yeah.
and I've got a nice portfolio of investments as a limited partner in multifamily
Mm-hmm.
assets across the country.
So tell me about your first deal on an apartment building, on the first multifamily you did. How did you find it, and how did you kind of like pull the funds together to acquire it?
Yeah, so actually, I was just looking on the multiple listing service, just sort of perusing,
Mm.
and if memory serves me, I think I was looking at this property. I found this 7 unit in near downtown Salt Lake, and uh, I think I did some math wrong. Actually, I shouldn't admit that, but I actually did some math where I thought, "Wow, this is a amazing deal," and so I called up my soon-to-be business partner, and we started looking at it, and we got the math right, but found out that it was an out-of-state owner selling two assets that were right across the street, a 7 unit and then a 13 unit.
Yeah.
They were in really bad shape. I mean, they were occupied, but properties built early 1900s, and kind of bigger homes that were converted into apartment units, and so uh, we ended up getting both properties under contract, not having all the equity that we would need ourselves. We felt like we could figure it out, and knew what we needed to do, and so we got them under contract, and then started plans for the renovation work, and it was a fairly heavy lift, and then just started reaching out to friends and family. He was on the broker side, so the commercial real estate agent broker side, and so we were both a known entity in the space, and so we were able to get fairly high leverage bridge loans at the time. I think we may have got to 80% loan to cost. It may have been 75, but
Mm-hmm.
ultimately raised between the two properties about $1 million from limited partners. We put a little of our own money in, but not a whole lot. And then
Any financing from any kind of like institutions?
yeah, there was a local credit union
Okay.
that funded it. It was actually a construction loan, but it was very much a bridge loan,
Yeah.
but they tagged it as a construction loan.
I love credit unions. I mean, they're really, it's, you're planning to improve the community and all of that. I mean, they're all about that, and they make it easy to get a loan. I mean, the first loan I got when I got, a long time ago, the first apartment building I bought, yeah, it was a credit union. I went to the banks and stuff like that. They didn't care. They didn't want to lend
Yeah.
money to me. They saw me walk in and they said no. It didn't matter what the project was. They would never lend me the money. I was
Yeah,
18
they're
years
great.
old at the
They
time.
can be more friendly. They can also
Yeah,
take their time as well. They have their own agenda, and
yeah,
they're not always efficient, but
yeah.
certainly a good source of funds.
Yeah, that's right. I mean, and I think often the credit unions are overlooked. I think people should pay more attention and then really try to reach out to them, because again, they're community focused. If you're gonna go and improve the business, you're improving like two buildings in downtown Salt Lake City that were dilapidated or not very well maintained, and now you're gonna make some massive renovation. I mean, they love that. They love to be part of that.
Yeah.
So that's good. And then the rest of it, you basically got through friends and family. So that's good. You
Yeah.
never have enough friends.
If you keep growing, you run out of friends, and then
Yeah, yeah,
you need institutional equity, but
yeah.
there's
Well, one of my favorite saying is always like, it doesn't matter how much money you have. You just like you're always short a couple of millions. It doesn't matter, and that's true. As you people think, oh, I'm just starting real estate, but eventually I won't need any money from anybody. I'll just fund all the deals myself out of pocket and stuff like that. And so, yeah, you kind of have that intention at the beginning, but then you find bigger deals, and it's I'm short. Like I'd like to get some people, or I want to minimize my risks. I want to bring some partners in to kind of like share the risk in this project and stuff like that. So
Yeah.
always network, always.
Yes.
So that is very. And then after that, so how did the debt? I mean, you call yourself a debt provider. Are you a loan originator? Are you certified, or is this something that you're just very creative and people call you and say, I know where the money is, kind of thing?
Yeah. No, there's several titles I've used through the years, and the easiest to understand is a commercial real estate mortgage broker. So the seat I sit in, investors will come to me, they're my clients, and they'll say, okay, Paul, we need a loan for this property. So rather than them knocking on the door of two or three or 10 or 20 lenders, and they, of course, there's some known entities like the local credit unions, but there's all sorts of lenders that I have access to that the general public would have no idea of or how to reach,
Yeah,
from
yeah,
CMBS lenders
yeah,
to life companies to private lenders to non-brick and mortar banks to banks based out of state that lend in our state. And so I'm with a company called Stack Source, and the reason I came to the company was the technology that's been
yeah,
developed to really facilitate the process. So the traditional mortgage broker and in the commercial real estate space, um, and there's all sorts. There's large firms. There's people that have their own LLC that work out of their home, and but regardless of where you are, the traditional model is that mortgage broker develops relationships with lenders,
yeah,
and they keep track of them mentally or maybe in a spreadsheet or an email. And so there's 10, 15, 25 different lenders that they might be aware of where they can get deals done, and client comes to them and they send it out to that relatively small network, and hopefully get a couple lenders that want to work with that, and simplifies the process, becomes a single point of contact for the client. They're an advocate. They're in the space. They're knowledgeable. So there's a lot of benefits of working with a broker.
yeah,
But the reason I came over to StackSource was we've developed a lender database of over 1,700 loan programs and lenders nationwide for all asset classes and loan types. So whether it's land or development or new construction or bridge or permanent or mobile home parks or multifamily or office or retail or industrial hospitality, we plug in the information about the deal in our platform, and it's going to come back to us and say you've matched with 43 lenders, or you've matched with 16 lenders based on the loan to value that's desired and the geography, and then our technology pushes out that information after we assemble it in a manner that's digestible easily by lenders.
yeah,
So then they can wrap their head around it. They can say, hey, we're not interested, or we are interested, and they start submitting bids, and then we have a follow-up process to make sure we're delivering as close to what the best the market can bear,
yeah,
rather than just finding a viable deal
yeah,
for our clients. And so
yeah,
that's really uh, what I do. I really connect the investor, the general partner, with the lender, leveraging that technology and my expertise to
yeah,
help structure the deal and find the right debt.
yeah. Yeah, and the other thing too that you mentioned that is pretty important is that a lot of the investors, they say, well, I don't need a broker. I want to go directly with the lenders. I'm going to ask some banks, blah blah blah. But I mean, as you said, is that you may think like out of the top of your head, like if you know a lot of banks, you probably know 30 banks, and then but then you have other sources of funding, like life insurance companies. You have, as you mentioned, like CMBS, and then you have also out-of-state banks, banks that are not necessarily working in your state. You don't know that they're lending in your state, but that they can assist. So I think this is where you're providing a lot of the value for people, is that you open up a whole bunch of new lenders that they don't have access to. They don't know that they exist, and they don't have an efficient way either of connecting with them and finding that sourcing.
Yeah, yeah. A pretty industry standard is a 1% fee, for the broker's efforts and work.
Yeah.
And if you do the math on like a 5-year term, all you need is a 0.5% better in an interest rate, and it's gonna make up for that fee. And there's some other advantages of working with the broker. Admittedly, I sit in a biased seat, but if you go direct, and by all means go direct if you want to do that. But how often are you going to transact with that lender? What sort of rapport do you have? Every year, every other year, every 4 years?
Yeah.
I'm transacting with them every week, every month. They know and trust me. They have a lot to lose if they screw up the deal and have a significant retrade or something, because then they lose me as a source of business to them, or that mortgage broker, if you will.
Yeah.
As I've surveyed the marketplace, I'm shocked half the banks are even in business. I'm shocked anyone does loans with them. I'm like, how on earth do you convince anyone to take these terms when it's so obvious there's much better terms out there? And again, there's an ease in a relationship, but I'm not saying there's not value there, but there is a material cost. And so different strokes for different folks, but it's certainly some benefits, and a single point of contact is an advantage as well. This is a team sport, especially as you get into commercial. There's all sorts of players. It takes a village, and if you're wearing all the hats, you're not going to scale. You're not going to go that far.
Yeah, that's very true. I mean, I think this is real estate investing is definitely a team sport. You have to build your team, especially for us. I mean, we do like out of state investing, so we definitely have to trust the team on the ground and all of that. I mean, we wouldn't be able to be where we are today without the team, and listening to everybody's expertise, and so that we can grow the business that way. So the kind of deal, what kind of like financing do you do? I know you mentioned, like I mentioned in the intro, kind of like apartment buildings, student housing, senior housing projects. These could be like mainly like commercial kind. Do you only do commercial financing, or do you also do like residential financing for rental properties?
The bulk of my business has been in that multifamily or the housing space, but I'm not licensed to do residential. Our company won't do residential, nor do I have interest in doing that. It's a different animal, and it's still real estate, but there's a different skill set and parameters for residential loans. So in the multifamily space, anything 1 to 4 units falls under that residential umbrella, and anything 5 units and above is commercial. So you're doing commercial loans.
What about if I have a portfolio of single family rentals? Do you do that to be considered a commercial loan at that point, or no?
Yeah, there are a handful of lenders that do portfolio loans, and they're more nationwide, kind of non-recourse, similar to a Fannie and Freddie loan, although Fannie and Freddie don't do those currently. They've dabbled with them, but haven't really made the model work. And you can get non-recourse, you can get full-term interest only on lower leverage. Typically, your rates for that are going to be 1 to 2% higher than you'd find from your residential Fannie Freddie loan.
Yeah.
So if you are building a portfolio, you can get to a point where you're just fannied and freddie'd out, and so you need to look at something like that, and then you can do a portfolio loan where it's one payment, all the assets sit under that. There can be release clauses and provisions for that if you need to trade in and out of or one or two properties. But that is a commercial loan that exists.
So that would fall under your umbrella, because we do have some investors that they're building they start with one rental, two rentals, and all of that, and then all of a sudden they end up like they have their 10 mortgages, and they still want to grow. And I say, how do we structure the deal after that? Or sometimes they just can't get the traditional financing. I mean, they just so what are some of the parameters for the portfolio loans that you saw? Because sometimes, like I was about to say, is that some of our borrower or investors, they don't have necessarily the W-2 income. They're real estate investors, or they are contractors or something like that. So they don't have they have a slightly different income that people are or they have a good credit score, but they want to be able to find a loan where it's not dependent on W-2 income.
Yeah. So this will be a long answer, but I'll so buckle up. But we'll hit all the salient points. And what I'll do is just speak in general terms for commercial loans. And I'll caveat this and say there's a loan for everything out there. When we get more creative, or it's just solely relying on the property, you're paying a premium, right? I'll tell my clients, hey, there's a loan for everything. You just may not like the terms, right? So in order to get the best terms in the commercial space, there's really two underwriting buckets that need to be satisfied: the credit profile of the borrowers or sponsor, and then also the credit profile of the asset. So on the sponsor side, what we're looking for in the commercial space are a handful of things, and it's a pretty quick review. First off, we want to see combined net worth equal to the loan amount. So if we're looking at $1 million loan, we want to see $1 million of net worth from whoever's trying to borrow. And that could be one individual, it could be 5 individuals collectively aggregating their balance sheets to get to that figure. We want to see liquidity equal to about 10% of the loan amount. So again, using that $1 million example, 100,000 in liquid assets. That's cash in a checking savings account, or equities and just highly liquid assets. Any retirement accounts, even if it was in cash, do not count as liquidity.
Okay.
And then looking for a credit score above 680, and it's rare that, not entirely rare, but less common that loans are based on a credit score, whereas a residential loan, if you have a 780 credit score, you're going to get a better rate than 620. It's more of a price of admission in commercial. So 680 and above, you're in the game. There's a few loans where you get a little better rate, but that's not super common. It's just an entry gate.
Yeah.
And then this is more nebulous, but experience is important in commercial. Lenders want to know that you've done something in the past. So as people are starting out, it's a good idea to partner with someone to leverage that person's experience. Again, it can be done. Everyone's got to start somewhere. It may be a little harder to find that lender. So that's what they're looking from a credit profile. And then there's the asset. So we're just talking about a what we call a permanent loan on a stabilized asset, meaning it's producing income. It's a minimal amount of vacancy in the property. And so there's the loan to value component, which a common number in multifamily is 75%. And that's what everyone gravitates towards. They see that.
Yeah.
And it's like, oh, great. It's $1 million property. I need to put down 250,000 and I'm good to go.
Yeah.
Well, unfortunately, it's not that easy. So because it's an investment property,
yeah,
the income needs to support that debt. So there's a debt coverage ratio.
Yeah.
And that's simply the net operating income on an annual basis divided by the annual principal and interest payments of the loan, of the proposed loan.
Yeah.
Taxes and interest are covered in the NOI. That's an operating expense. It's not the PITI like you might find in residential.
Yeah.
So, and it's based on in-place income on a permanent loan. It's not based on where it's going. And so, again, I will get people reaching out all the time saying, "Hey, I've got this property. What sort of loan can I get?" And I'm always, the first thing I ask, what's the net operating income? And then we do the math.
Yeah.
To back into a number of what debt that will support. And right now, with interest rates in the 6, even 7 range, there's been some decreases. Maybe high 5s are findable today.
Yeah.
But based on that, what we're seeing is 60%, maybe 65, even 55% loan to value is not that uncommon.
Really? Wow.
Someone was trying to acquire a property.
So what's your target debt coverage ratio?
It's 1.25.
Okay.
So there's different lenders. Some will go to 1.2. Again, it helps to have a longer amortization. So a higher rate at a 30-year amortization is actually a lower payment than a lower rate on a 25 or 20-year amortization. So that's factored in, but it's really, the lender wants to see the income to be 125% of what you've got to pay them. So there's some spread, there's some cushion, there's some profit in the deal to make it work. And it's the lesser of those two. And so it's incredibly rare that we bump up against loan to value, even though that's what everyone gravitates toward. It's easy to get their head around because how do you calculate that coverage ratio? And
but it really starts with the debt coverage ratio. So figure out what is the mortgage payment, principal and interest that can be supported by your net operating income, and that will give you your loan to value ratio. That's how the banks are working.
Correct. Yeah. So if you have a financial calculator, that's the easiest way to do it. There's different apps that you can get on your phone. You take your net operating income. People may have to listen to this a couple of times, but you take your net operating income, divide it by that 1.25.
Yeah.
Divide it by 12. That gets you to your monthly debt payment because you've factored in that ratio. You put in your interest rate, your amortization, and then you solve for the present value of that, and that will give you the loan amount.
Yeah. Okay.
I probably lost half the people, but
pretty simple. But I think you can even do it in an Excel spreadsheet and kind of like work for that. Yeah. Oh, that's good. Very good. So what's happening? I mean, there's a lot of changes that happened in the industry right now. So if I'm looking for deals like multifamily deals or other commercial deals, or even like rental portfolios and stuff like that. So what's happening? What's happening with the industry right now? Are they tightening anything in terms of the lending, or are they just like, no, that's just the interest rate are higher, but it's just the same thing as usual? It's just you apply the same rule, the interest is higher, then of course it's going to affect the loan to value ratio. And so what are you seeing from your perspective?
Yes, it's an incredibly challenging time, and I think there's opportunity in challenge and difficulty, of course. Things have moved incredibly rapidly, and so this year, if you go back to the meltdown of 2008, it was it was a bad time for real estate, right? That was the cause of the whole meltdown, and it was pretty simple then. Lenders just didn't lend. It was just
Yeah.
everyone was closed for business. You knew you weren't doing anything.
Yeah.
Well, now it's like, okay, some data show we're in a recession. The
Yeah.
government's changing the definition of what a recession is, so they
Yeah.
look better.
Yeah.
And so where are we? Is inflation going crazy? Are we subsiding it? What's the Fed going to do? They said they're break the economy to curb inflation. So everyone's just, it's moving so quick. Interest rates have come up. It's been very hard for lenders that continue to need to lend.
Yeah.
They say they're open for business. However, they're trying to wrap their head around it. The loans, because interest rates have gone up so much, it's harder to get loans to size to hit that leverage level we're more accustomed to, in that 65, 70, 75%, even 80.
Yeah.
And that's almost impossible. And the term that I'm hearing now that's emerged over the last 2-3 weeks is the cash in refinance. And I've got a couple of clients that are faced with that, meaning
you have to
they
put
acquired
money
the
in to
property.
refinance to that.
Yes.
Wow.
Yeah.
So why would you do that? That's interesting, because the
You know
interest
what?
rate, I'm suspecting that they had a low interest rate. They want to refinance. But why would you refinance it out? Oh, that's because it was the end of the term or something like that, and now they have to put money. Ah,
In
interesting.
commercial and multifamily, everything was so good, interest rates were so low.
Yeah,
Bridge debt was a more economical way to acquire properties,
yes,
to get to that 75 to 80%, because cap rates were so low, values were so high. You
yeah,
couldn't get it to size. So not everyone, but most people did higher leverage bridge loans. And that's the scenario here that comes due in 12, 24 months. And they executed their business plan, they increased
yeah,
net operating income, but they were planning on a 4% interest rate to go on a permanent loan, but now it's 6.
yeah,
That's a big difference. And
yeah.
so they don't want to sell. They've got a loan coming due. And so unfortunately, there's scenarios, and I think it's going to be more common, where cash has to come in to close the refi based on that sizing. So it's certainly not fun to deliver that news.
Yeah.
And lenders will say, we've experienced this a lot, where lenders will say one thing at the start of the process, and it's a different landscape 2 months later when we're trying to get to the closing table. We're at loan committee, and they're coming back and saying, hey, we can't do this now. And so it's been a very challenging time, but lenders are still active. There are still deals. Sellers are starting to realize that we're not in a 3% cap rate world anymore. They're starting to catch up. They're still lagging and not wanting to accept some higher cap rates, but we're seeing that, and people are cautious out there. The lending environment is definitely cautious, but by and large, active. What has really slowed down is some bridge lenders have closed doors, and then construction lending is tougher to get done. But that's again why I like sitting in my seat, and I've talked to several bankers and folks that are super slow. I'm as busy as ever. I think people need not only to find lenders that are lending, but every dollar counts. So finding that absolute best rate, or finding that lender that'll do the construction to keep their project going because they're optimistic about the future, they need help. So we do the best we can to help them and get deals
there
done.
are people that are optimistic about the future. See, I'm not the only one.
Fundamentally, I'll say this: we needed a slowdown. Things were too robust for too long, and we were overdue for a correction. And I think it's healthy overall for things to come back and reset a little bit. But fundamentally, there is a housing shortage. That's not going to go away, and that's only going to be exacerbated because there's going to be less building. there's not going to be any single family home building at all for the next
Yeah.
couple of years.
Yeah.
So where are people going to live?
Yeah. Yeah, exactly. And I think that high interest rate at this, the fact that it also increased so quickly. I mean, you have builders like in, I know in Vegas and the Vegas area and Phoenix, Arizona and stuff like that, that they're going to be caught. They were very surprised by the increase in interest rate. And all of a sudden, they can't sell the house because the interest rate is too high. And then there's no demand for these houses. So it's just like,
Yeah.
what do? They're going to lose money on these houses. They've already committed the funds. They bought the material. They bought the material. They build the house. What are they going to do? So that's the problem. That's the one big problem that I see is that we're going to kill builders, and
Yeah,
then
that's happening.
right, and then we're already in short supply for housing. So yeah. So yeah. So I think in terms of the and then in terms of the whether we're in a recession or not, we always know later. Like we never know like when it actually is happening. I mean, we had Q1 and Q2, as you know, were negative GDP growth, which is kind of like one big indication of a recession, but it's not the only one. They're looking for other signs of like high unemployment, which we haven't seen. They're looking for a slowdown in business, which we haven't really seen yet. We're just kind of like getting some hints of that right now with the layoffs and all of that of some companies. But yeah, I mean, it doesn't, if beside the interest rate, it sure doesn't feel like a recession. It feels like things are moving along. It's just the Fed doesn't seem to be on the same page as everybody else. So they should share what page they're on, and what they're seeing that is causing them for doing all this work here.
Yeah. Well, they'll overcorrect, and
Yes.
it'll create opportunity. That's what it will. Like,
Yeah. Yeah. That's what everybody's saying. As usual, they're going to make a mistake. Well, they've already made a mistake last year by not responding fast enough. Then they responded too fast. Now they're going to over respond. And yeah.
to the problem they created. They could have just curbed some of the stimulus, right?
Yeah.
And
Yeah.
but anyway, that's
Yeah.
a whole other topic.
Yeah, exactly. So that's good. So Paul, so if people are, they're looking for financing and we've sold them on the whole broker idea because you have access to additional source of funding that they don't even know about, and they don't even know who they're going to call. So how can they reach out to you and to kind of like start figuring out like their financing needs?
Yeah, so there's a couple ways. You can always email me. That's the best to reach me. I'm not sure if you have show notes, but that's just my first dot last name at stacksource.com. We also have resources on stacksource.com, and you can actually go there and enter in the information about your deal.
Yeah.
And so in real time, it'll narrow it down and say, hey, you matched with these many lenders, and we don't reveal those until we engage with the client. Once we've set up some sort of agreement there, but you can get a feel for that. We've got data feeds for interest rates for all sorts of different types of loans. We've got a robust blog there where people can learn about commercial real estate finance. And so stacksource.com is a great resource. And ultimately you could find me through that website as well.
But yeah, that sounds, so at least it sounds, so at least people should go and visit your website, get some information and education there so that they know what to look for. It sounds like you have a lot of information about the mortgage rates and trends and stuff like that. So people should go there and get educated. And if they like what they see and they need some funding, then they can contact you at
I'd love to help. Yeah.
Yeah. So Paul, well, thank you very much. Thank you for sharing your experience and knowledge and optimism about the future, I would say. And yeah, so thank you very much. Talk to you soon.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.